Ladies and gentlemen, Mr. Cropper here with a couple of books on economics, the general theory of employment, interest, and money, and Buffett, the making of an American capitalist. This one's by Roger Lowenstein, and the other is, of course, by John Maynard Keynes. There are a couple of amusing quotes from chapter 12, and God help me, I did not read the entirety of Keynes' book, but from chapter 12, on the recommendation of a friend from Australia, I did read this chapter, and there are some amusing things in it. So I'm going to start with a quote on page 150. Quote, "It is probable that the actual average result of investment, even during periods of progress and prosperity, have disappointed the hopes which prompted them." And what that means is people may make calculations about their investments, but on average, across period after period of history, those calculations were wrong. And, quote, "If human nature felt no temptation to take a chance, no satisfaction, profit apart, in constructing a factory, railway, a mine, or a farm, there might not be much investment, merely as a result of cold calculation." So saying on average across the years people have been wrong. Investors are just wrong. Things are built, railways and so on, and steel mills are erected according to figures that turn out not to come true again and again and again. And we owe the growth of the economy, and we owe all of the investment in the economy, or the greatest part of the investment in the economy, not to cold calculation, but to something besides cold calculation. Cold calculation would not result in economic investment, would not result in the economic growth we've had, if it were not for some other factor, which has been called, for example, the animal spirits, some sort of irrationality. So that's Keynes' opening salvo in this video of mine. But going a few pages down to 156, he brings up a metaphor of professional investment bankers being similar to those in a newspaper competition in which the competitors have to pick out the 6 prettiest faces from 100 photographs. So it's kind of like a beauty contest with photographs. And he says the prize is awarded to the competitor whose choice most nearly corresponds to the average preferences of the competitors as a whole. So, whoever gets the closest to the answer that everybody else on average answered is the winner. Quote, "So that each competitor has to pick not those faces which he himself finds prettiest, but those which he thinks likeliest to catch the fancy of the other competitors, all of whom are looking at the problem from the same point of view. It is not a case of choose." So you got a bunch of people who read the newspaper, and they all get to choose the 6 prettiest, and they're all hoping to win by getting closest to the average of what everyone else picks. It is, quote, "It is not a case of choosing those which, to the best of one's judgment, are really the prettiest, nor even those which average opinion genuinely thinks to be the prettiest." So you're not even saying, okay, who would most people say is the prettiest here? "We have reached the 3rd degree, where we devote our intelligence to anticipating what average opinion expects average opinion to be. And there are some, I believe, who practice the 4th, 5th, and higher degrees." Now that's just a little bit silly there, but he's saying that the stock market is a place where you're not trying to figure out the value of a commodity, or even what other people might think the value of a commodity is. You're trying to figure out what other people think the value of the commodity is. And there are people who are even further detached, he says, than that. Now that's a fair criticism, I think, of some of the modern stock trading, where you don't hold anything for more than a couple of hours or days or weeks. But let's continue a little bit. If the reader interjects that there must surely be large profits to be gained from the other players in the long run by a skilled individual who, unperturbed by the prevailing pastime, continues to purchase investments on the best genuine long-term expectations he can frame. So if the reader says, wait a minute, there could be someone who's intelligent and buys things because of their value rather than because of what he thinks other people think. And he says, okay, but we have to answer this reader who brings this up, first of all, that there are such serious-minded individuals, and that it makes a vast difference to an investment market whether or not they predominate in their influence over the game players. But we must also add that there are several factors which jeopardize the predominance of such individuals in modern investment markets. What could jeopardize a person acting on their best judgment of the value of a stock? Quote, investment based on genuine long-term expectation is so difficult today as to be scarcely practicable. He who attempts it must surely lead much more laborious days and run greater risks than he who tries to guess better than the crowd how the crowd will behave. He who attempts it must lead more laborious days. Now that's funny, because Warren Buffett is definitely the guy that he's talking about there. The person who makes large profits by purchasing investments on the best long-term expectations he can frame. That's what Buffett does, and he must therefore lead more laborious days. Well, let me just mention a couple of little tidbits from Buffett's life. First of all, his office that he works in. There's no computer. There's a phone. Now, he may have a computer nowadays. He probably does. But he just had a phone, and not a bank of phones. One phone. And any given time that you went into his office, you're as likely to find him reading through some portfolio as talking on the phone. So he did not lead the busy and harried life. Another anecdote from his life was when he traded from home. He used to do his trading from an office upstairs at his house. And his neighbor once came over and was talking to him, happened to strike up conversation with him, and Buffett said, I'm an investor. If you've got some money, why don't you let me take about $5,000 and see how I do for you? And he said, Buffett himself is telling this anecdote in a video of it, of his talk I saw, of one of his talks. And he said that his neighbor was not convinced by this guy who was always out in the yard playing with his kids in the morning. His kids are on the swing set or something in the morning when his neighbor is getting in the car in his suit and going to work. And his neighbor was a little more suspicious of whether or not Buffett was even productive, standing around in a t-shirt and jeans, swinging his kids on a swing set in the morning instead of going to a productive job. But Buffett did turn out to be productive, and that guy did turn out to make a bad decision in not loaning Buffett not investing $5,000 with Buffett like he asked him. But a few more things about Buffett and his theory compared to the predictions in Keynes here. From page 307 of The Making of an American Capitalist. The premise of Buffett's career was that stock picking, though difficult and subjective, was susceptible to reasoned analysis. Now that's what Keynes just said. He said, surely there are people who have above average intelligence could make a profit at it, but it's just too difficult. Almost impractical today, said Keynes. Well, Buffett says that it can be done. Quote, occasionally certain stocks sold for far less than they were worth. An astute investor could profit by buying them. Now, that's almost obvious. Once in a while, the market's going to undervalue stocks. In fact, I heard him and I heard Charlie Munger both given the analogy of the stock market being a Mr. Stock Market. He's a guy. And some days he offers you values, and other days his prices are too high. He's just crazy. And it's up to you to trade for your benefit with him. He'll trade with you any day. But some days his prices are too high, some days his prices are too low. In contrast to this, there was something called the efficient market theory that cropped up in the 60s, I believe, maybe in the 70s. Quote, in place of the rather modest maxim that we've just heard from Buffett that sometimes stocks are undervalued, in place of that rather modest maxim, scholars substituted a seductively simple but unifying design, the efficient market theory. In a nutshell, the theory said that at any moment, all the publicly available information about a company was reflected in the price of its stock. So the stock will tell you what the company is worth, or the information available to the public determines what the stock is worth. Well, we skip a few pages down here. Going to go to page 315, quoting Warren Buffett. And he's talking about these efficient market theorists, these academicians who believe that the price of the stock always reflects all the publicly available information. He says, they observed correctly that the market was frequently efficient, and they went on to conclude incorrectly that it was always efficient. The difference between these propositions is night and day. So, it may be efficient quite a lot of the time. And maybe it's only rarely, 5% of the time or less maybe, that the market is wrong in its valuation. But those are the times to buy, when the market is undervaluing something, according to Buffett. Now, Charlie Munger is quoted somewhere else in this book as saying that it's very hard, it's very difficult to find these values. And he says, why should it be easy to do something which, if you do it 2 or 3 times, will make your family wealthy for life? Why would that be easy? Of course it's difficult to find a stock that's undervalued. But that's the way to get rich. That's one of the best ways to get rich. That's one of the ways to get richest. Now on page 314, we go back just a page here to get a quote about the people who were studying in academia. They're studying this efficient market theory. And there's all this epistemological literature studying all these people. And, quote, there were no studies of the anomaly that might have left the theory with a mortal puncture, the consistently superior record of Buffett and others. Now here are some of the others that he mentions. Keynes, which I don't think he means John Maynard Keynes, who I've just quoted from, Graham, John Templeton, Mario Gabelli, John Neff, and Peter Lynch, to cite only the better-known names. So those are some other people who were successful in the stock market, despite the fact that people like John Maynard Keynes say it's all just a lottery and you can't invest. The best way to make a living or any money in the stock market is to guess what the other guy's guessing about the other guy. It's just the only way to do it, says Keynes. But Buffett shows that you lead a life of leisure if you dispense with Keynes' idea there. Quote, the records of such investors who broke the norm and actually made money by investing wisely instead of just guessing their neighbors' guesses, the record of such investors were ignored or wished away by these academicians. Tony Thompson, an investor manager at Bankers Trust, airily dismissed Buffett as a red herring. Buffett's record signified nothing. Absent 75 years of quarterly data, Thomas argued, one couldn't establish whether he had done it with brains or luck. So he just dismissed Buffett and said, could have been luck, who knows? We can't say. Quote from Burton Malkiel, a Princeton economist, quote, thus the jury is out on Mr. Buffett. So, is the jury out on Mr. Buffett? Not for me, ladies and gentlemen. quote now from page 333. What mattered most was confidence in one's own judgment. This is according to Buffett. This is Buffett's idea, his philosophy, the way he worked. What mattered most is the confidence in one's own judgment, from which would flow the Kipling-esque cool to keep one's head when all about you are losing theirs. Now, that is a very small line from Ayn Rand's favorite poem by Rudyard Kipling called If. If you can keep your head when all about you are losing theirs. That is precisely what Buffett does. When the stock market goes kablooey, Buffett jumps in and makes money. When people were quoting Coca-Cola as a good purchase at $88 a share, they were saying, the earnings, you can make back your money in 10 years. After the crash, when it had fallen to $25 a share and bottomed out at like $12 a share, they were staying away. By and large, the Wall Street houses said, it's a scary time to buy. No one wants to stick their neck out. Buffett looked at it and he said, how could it be a good purchase at 88 and not a good purchase at 25? And he subsequently dumped several $billion into Coca-Cola and today is one of the largest owners. So, it is exactly from Kipling's poem, to keep your cool about you when all others are losing theirs. Quote, in market terms, if you knew what a stock was worth, what a business was worth, because a stock isn't just on the stock exchange, it represents some people doing business somewhere, which is something that is lost sight of in the stock trading industry. If you knew what a stock was worth, then a falling quote was no cause for alarm. See, Buffett had knowledge of what Coca-Cola was worth, what it was likely to do in the future as far as sales were, how many drinks were being sold in the United States versus other countries, and therefore the room for growth. He had some of these things. He knew some of these things about the company. So when the stock price starts falling and falling and falling, he's not alarmed. What does he do? He buys more of it. He dumps more money into it. He buys it while it's at a good price. That's reasonable, for heaven's sakes. Continuing the quote. Indeed, before he invested in a stock, Buffett wanted to feel sufficiently comfortable so that if the market were to close for a period of years and leave him with no quoted price at all, he would still be happy owning it. This sounds extraordinary, but one's house is not quoted day by day, and most people do not lose sleep over its value. That is how Buffett looked at Coca-Cola. Contrary to John Maynard Keynes' statement that such people would it is scarcely practicable to trade in such a way, and he who attempts it must surely lead much more laborious days and run greater risks. That's absurd. How do you run a greater risk buying Coca-Cola at $25 than $88? And why are you supposedly having more hectic and harried days when all you're doing is looking at the value of a stock versus the price that it is on the market? I mean, Buffett didn't need anything more than the various publications by these companies, their yearly or quarterly quotes and stuff, plus, newspaper headlines and stuff. That's all he needed. And one telephone that wasn't often busy. So, Keynes is wrong, wrong, wrong. And Buffett proves him wrong, wrong, wrong. There we go. Just a quick installation there on some economics. Maybe more to come on Buffett in the future. He sure is an interesting character. And maybe more to come on Keynes.